This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. I'm Sonia Shenoy and joining me in the studio as always is Nigel D'Souza and Rima Tendulkar. Well, guys, good morning. A bright new day.
Good morning, yeah.
And looks like it's going to be not a bad one.
Hopefully it's not. Yesterday actually was a decently okay trading session thanks to Reliance Industries. But today I think you'll require the other names as well to perform. Lower dollar, I think that's going to bode well for us.
I think Reliance, Tata Motors, these are stocks that really performed yesterday, right? Hopefully they'll take it forward today as well. But so many cues as we kickstart trade. So let's get straight to that. As we were telling you, it's strong global cues, you'd have to say. So the Dow was up in the green, but I think it's all wait and watch mode because we have a lot of important data coming through in the next couple of days. The inflation data in the US, both CPI and PPI comes out, and those could give us some cues on what the Fed is going to do in the end of July. The expectation this time around is that there will be a rate hike yet again in the Fed policy. So all eyes will be on that. Now, the Nifty, as you know, Nigel was also pointing out, yesterday was a bit of a lackluster day. We consolidated, we came off the day's highs. But there were some pockets that did well. IT was under pressure, but on the flip side, there was Reliance, Tata Motors that performed pretty well. So keep an eye out on those pockets. What the bulls would like is that both foreign and domestic investors bought in the cash markets yesterday. And now it's almost 9,000 crores of buying from FIIs in the month of July alone. So it's a pretty hefty sum that has come through from the foreign investors. The market strength continues. There's no two ways about that. The uptrend is intact, just that there may be a little bit of volatility along the way, especially now that we're getting into the thick of the earnings season or into the main pocket, which is the IT sector. And there the results are not expected to be good, especially with HCL Tech. So perhaps there could be some, trepidation ahead of that. There's TCS, HCL Tech tomorrow, followed by Wipro as well as Federal Bank on Thursday. So a lot of earnings coming through in the next couple of days. Once again, the focus continues to be on the auto stocks, especially after, most of them hitting record highs, Tata Motors, Bajaj Auto. So perhaps there could be some more traction over there. But Rima, barring TCS, or rather barring the IT space, looks like the market seems to be in fine fettle.
It does. It's been in a range of 19,300 to 19,500 for the last 4 or 5 trading sessions. If you could just pull up the day's high and the day's low for the last 4 trading sessions, and you would see that the Nifty high was about 19,523, and on the way down yesterday, the Nifty hit a low of 19,300. So for the last 4 trading sessions, the range has been 19,500 to 19,300, and I guess we're just consolidating, spending time in this range, and for any big move, this range needs to be decisively broken. Another word on the US market. So while the frontline indices had a tepid session, they closed up with gains of about 0.5%. Russell 2000 gained 1.6%. So the small cap index there was the big outperformer. And there were 3 Fed officials who spoke yesterday. They're the non-voting members, but they do participate in the policy meeting. And all 3 of them have indicated that higher interest rates will be needed to curb inflation. We had the Cleveland Fed President Loretta Mester, who said that inflation remains the #1 problem in the U.S. economy. San Francisco Fed President Mary Daly said that Fed will likely need to hike rates a few more times to get inflation fully under control. And you also had the Fed Vice Chair for Supervision, Michael S. Barr, who said a bit of work needs to be done to achieve restrictive rates. Another word, getting back to, the Indian markets. Yesterday, in terms of the flows, both the DIIs and the FIs were buyers in the cash market. The numbers are up for you on your screen, but the FI buy figure has been coming down. We highlighted this yesterday. Yesterday it was about 590 crore of cash. The day prior, it was 790 crore of cash. And this is a marked come down from the 1,000 to 2,000 crore of FI buying inflows in the markets that we've been seeing. In terms of cues for the day, as usual, Tuesday. So you've got the Fin Nifty expiry, and you also have a GST council meeting, which begins at 11 a.m. So we're going to be watching out for developments there. Nigel.
Well, the top points in terms of trade setup today, we have a softer dollar, which is good, and crude oil prices have come off a little bit. So the global cue for me, those 2 are positive. The other factors, yesterday there was some unwinding of positions, both on the Nifty as well as the Nifty Bank. The open interest was down by around 2 to around 3%. Also, there was no fresh shorting, but there was unwinding or lightening of positions getting into this big earnings season. HDFC Limited, well, what a moment it's going to be. Today it plays out its final part in the Nifty Financial Services Index. Remember, HDFC Limited is not part of the Nifty bank. So that plays a bigger role in the Nifty Financial Services Index. And today we have expiry that plays out. So in the current form, it'll be the final time that it'll be playing its role. Let's hope that it plays its role on the upside. Well, let's focus on a couple of other cues then. The FIs in the FNO market, well, they lightened their positions. As I said, there was some unwinding of positions. You had the premium that's come down from around 100 points to around 50 points. So there was unwinding of positions, both on the long as well as on the short side. On the index option side, they bought some puts, close to 12,000 put contracts, but they continue to write more calls than puts. And yesterday as well, it was in the ratio of 2 calls for 1 put. But today, it's the Nifty Financial Services Index. So that takes, center stage, particularly in the second half of trade. The 20,100 call and the 20,000 put, both of them were fairly active in yesterday's trading session, which brings us to the broad range, the 200-point range, 19,970 on the downside. On the upside, 20,150. That's the broad range that, in terms of position. So that's about the Nifty Financial Services Index. On the Nifty, on the options side, well, you have the 19,350 put out. There was mixed amount of activity out there, but it appears there was some writing as well. So given that the premium out there was around 70 rupees odd, you deduct that 70 rupees from around the 19,350 odd mark and you get your stop loss for the day. So 19,275 becomes the important level to look at on the downside. And given that there was unwinding at 19,400 call, those call writers, they are moving out. Yesterday's high was 19,435, so that becomes a bit of a resistance zone. Now this morning, the GIFT Nifty is suggesting a gap up. I think that you shouldn't be going ahead and jumping in to buy the gap up. You wait for an intraday dip. You count on the 19,275 level odd holding out. Stay long on the index, keep that as the stop loss, and hope to get past yesterday's high, which was 19,435.
Okay, fair enough. The Dow futures are also quiet, just in wait and watch, tentative mode ahead of that key inflation data. So maybe you don't want to take any big bets either way. But we have lots to talk about on the show in the next 2.5 hours. So without wasting any time, let me tell you what's lined up in the first half hour of the show. We'll get you updates from the market across the globe. Dean Kim of William O'Neill and company will be joining in to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At around 8:30, we'll do a fundamental stock analysis. Ajay Bodke is our guest of the day. But first up, let me start with some equity views. Rhythm Desai of Morgan Stanley says the improving EBITDA margins are likely to lead to earnings growth in Q1 as India continues to be in the midst of an earnings upcycle. They are buyers of financials, consumer discretionaries and industrials going into the earnings season while avoiding external-facing sectors.
We have another opinion coming in from Surendra Goyal of Citi. Citi says they expect a 16% year-on-year EBITDA growth for the companies under their coverage and an 11% growth for the Nifty companies ex-OMCs. Earnings growth is expected to be significantly higher. They say EBITDA growth year-on-year is broad-based across financials, autos and industrials, but weak in energy ex-OMCs and metals. Going forward, earnings revision will be the key to watch given the sharp rally in the market over the past few months. Citi's June 2024 Nifty target is 19,800. They suggest buying the dips.
Well, let's get you some money market views then. Abhishek Goenka of IFA Global says that the rupee was the worst performing Asian currency last week, weakening from around 81.80 to around 82.70. He says that the hawkish Fed minutes, strong US jobs report and better than expected US services PMI have made a 25 basis point hike by the Fed in July almost a certainty. He says up move in US rates has pushed down forwards even lower, which is not helping the rupee either. He adds that key data this week from an overall dollar direction perspective would be the US June CPI print due tomorrow. He expects the rupee to continue trading in a range of around 81.60 to around 82.90 over the medium term.
Okay, 82.90, that's the upper end of the range. On the bonds, he says that tracking the overnight fall in US yields, they expect the market to ease here and remain range bound. He talks about how the inflation print tomorrow is likely to be a bit higher for the next 2 months, but within the tolerance band. He adds, with no major domestic cues, expect the 10-year benchmark bond yield to trade in a range of 7.11 to 7.16%.
And we have lots of stock-specific action to track today, and we'll get to it in just a bit in our special Top 10 segment. We're going to be looking at Car Trade Tech, Nazara Tech, Tata Communications, Mazgaon Dock Shipbuilders, McLeod Russell, PCBL, Sangvi Movers, APL Apollo Tubes. These are on our radar on the back of positive news flow. And chemical sector and Vedanta are the stocks on our radar that are likely to open in the red.
Well, that's about trade setup. We gave you the market views as well as stocks you need to focus on. But let's get a quick global perspective. Dean Kim, Head of Global Research Product at William O'Neill & Company, joins us on the show. Hi, Dean. Good morning. Thanks so much for joining in. What are you making of the global equity markets as of now? You know, as of last week at least, it seems you were ignoring all the bad news and only focusing on positives because global equities were running away. Do you think it's getting a little bit stretched on the upside and it calls for consolidation or maybe a pullback?
Yeah, it's a good point. I mean, if I look at the U.S. market, it has been going sideways for the past few weeks, but both S&P and NASDAQ, they're still hanging on to short-term moving averages. Fed's recent commentary of potentially raising another 50 basis points through 2 more rate hikes has certainly put a damper on the market that has rallied pretty hard in May and first half of June. So we're kind of going sideways at the moment. And so we're paying close attention to the market action to see if the indices can hold at the 10 or 21-day moving averages. We currently have both S&P and the NASDAQ in confirmed uptrend, but we may move to under pressure if they do break down below the 21-day moving average. So I think the next few trading sessions is going to be critical, especially on the back of the CPI number that's due out on Wednesday. So we have seen a steady decline in CPI in recent months. So if this trend continues, then the market has a chance to hold above key moving averages. However, if CPI comes in hotter than expected, then the market will have to yield to Fed's continued rate hike plans. Now, but the good news is the breadth has been improving. With over 50% of the New York Stock Exchange stocks trading above the 150-day moving average. However, we are about to embark on an earnings season with banks reporting starting on Friday. So we'll see what the commentaries are. But I mean, it's good that the market is holding above short-term moving averages. But I think CPI is going to be a critical data coming up on Wednesday.
Sure. Dean, hi, good morning. It's been a pretty impressive year, right? I mean, if you look at the NASDAQ, it's up over 30% this year. So it's done a lot of the good work. Do you see more upsides on the charts? And if not, is this a year where the U.S. markets could spend the rest of it in consolidation?
Well, I think, we will take one data at a time. Wednesday, we'll have to see what the CPI does. On the one hand, you have the Fed wanting to raise rates because of high employment numbers. But on the other hand, CPI has been telling us inflation is coming down and quite dramatically. So it's a classic case of Fed continuing to be behind the curve, and the market's going to have to struggle with that. So if we do get some good, cool CPI numbers, I think market has a chance to continue to rally. And we're looking at, for example, 4,500 as sort of resistance level at the S&P. We're currently sitting right at the 10-day moving average. And the next support is at the 21-day moving average, which is 1% away. But we are keeping an eye on 4,500 as a target through the summer and towards the year end. Undoubtedly, we're going to see some ebbs and flows in the market. But I think general trend is we're going to continue to rise higher throughout the year.
Okay, so if the CPI inflation cools off more than what the street is anticipating, you see the S&P 500 heading to levels of 4,500. Currently, it's at 4,409. What about the Nifty? It's trading above all its averages, considering we're at all-time high levels and nearly there. Any signs of cooling off? Any signs that markets are going to be spending time at levels of 19,000 plus instead of climbing higher? Or are you getting signs of falterish? Markets will falter from here.
Well, it's pretty interesting because India is the only market in Asia that continues to be in confirmed uptrend. Every other major markets like China, Hong Kong, South Korea, Taiwan, Japan, they're all under pressure. Yeah, I think those countries, they're sort of taking the cues of the U.S. market and seeing what the Fed is going to do. Because, as you raise rates, you're going to cut off demand. And these Asian countries, they are the source of supply of goods and services. So it kind of makes sense that these indices are sort of taking the cues from the U.S. India, however, is completely different because I find the India economy very robust. You have the massive middle class that's coming up in terms of income as well as spending. So it's quite a different dynamic, and India continues to do well. It is a bit extended. It's cooling off a bit at the moment, but I think in terms of the next resistance level, you're looking at the recent highs from a couple of weeks ago. But as long as the market stays above short-term moving averages, I would say it's still constructive.
All right, Dean, final question before we let you go. There is talk that could be a big stimulus coming in from China, which could bode well for metals. But will that be good enough news for the Chinese economy? Because clearly that unlocked trade didn't really play out for those that were very bullish on China. Would you change your stance in case there is a big booster shot that comes in from China?
Well, I think everybody's waiting for China stimulus. They have been they've been holding back on stimulus program. But once they start to come out with some stimulus, I think that's going to drive the rest of the Asian markets and India as well. But right now, it seems like the markets are pricing in sort of China government not doing anything for now. But once that news comes out, I think we're going to see a rally in those markets.
All right. You do track a lot of stocks in the Indian markets as well. So I'm just going to throw a couple of them at you. You're free to give us your view or not. Names like Reliance, of course, have done very well. Stocks like Tata Motors are sitting at all-time highs. Do you see incremental upsides in any of these names?
Well, I think Reliance Industries is a perfect setup. It just broke out from an early stage base. Looks like it had a powerful day a day before. So I would say Reliance looks really good. Tata Motor, it's been doing fantastically well, but it is a bit extended. So if you hold the name, I would continue to hold it, but maybe not start a fresh position here. Maybe look for a pullback. There are other names within auto space like Maruti Suzuki that's just breaking out from a early stage base. So that one looks pretty attractive.
Dean, we'll leave it there. Thank you very much for joining in. Nigel, since you brought up that subject about fiscal stimulus in China, yesterday I was reading that economists are talking about the risk that China may face Japanification, which basically means that China today is similar to where Japan was 3 decades ago. A bubbly real estate, very high levels of debt. All of them are now collectively, individuals and companies are looking to pay down their debt rather than, take on fresh debt, even though interest rates are low, and invest in the market. So what happened in Japan, as we know, is a very long period of sluggish growth. So economists are saying that there's one, Richard Koo. He's also written a book about balance sheet recession, as it's called. And he's saying that there is a risk that China may face Japanification, go down the Japan road, unless they announce a fiscal stimulus. So, they say that China may learn from the mistakes of what Japan did, right? Japan didn't announce a fiscal stimulus, and you know what happened. They went through a very long period of weak growth. So, economists are betting that China will have to announce that fiscal stimulus. It's not come yet, but, economists are, hoping for that to avoid China going down the Japan road.
A valid input, Rima, but going whatever that economists had to say will be very, very important. But our metal index is suggesting that it's definitely coming.
Yeah.
And today there could be some follow through because of the high expectations out there and a weaker dollar index as well. So good input, but I think a stimulus.
No, the economists are saying that China needs to do the fiscal stimulus. It has to come if they don't want to go down that road. So they are betting on that stimulus, and which, as you said, the market is also pricing in.
All right. Well, time to slip into a short break. You come back, we'll focus on all the stocks that we're lined up for you. We'll tell you more about why the stocks aren't focused. Don't go anywhere.
Welcome back. So many stocks to discuss. So without wasting any time, let's get our entire research team in. Yesterday, post-market hours, in fact, around 4:30, we were talking about this Vedanta and the fact that Foxconn has decided that they won't move forward on the deal with Vedanta. But, what do you see as the impact? I think a lot of people saw this coming as well, right?
Well, that's right, Sonia. It was reported, and now, in fact, it's official that Foxconn has said they will not move forward on the joint venture with Vedanta Limited. But Vedanta, I reached out to them, and they are reiterating that they're fully committed to the semiconductor fab project, and they have lined up other partners to set up India's first foundry. Now, they also go on to add that they have the license for production-grade technology for 40 nm, and they'll shortly acquire a license for production-grade 28 nm. Now, this is going to be important because we know that when this JV was announced, they were talking about a 19 billion to around 20 billion capex. Now, how do they fund that is going to be very, very important. So, the key factors that we'll be tracking is what is the total capex lined up for this? Who's the new partner that they're looking at? And will this increase the leverage on Vedanta's books? If yes, by how much? Yesterday, the stock didn't really react. You'd expect it to react negatively. So maybe the street is sensing that they have a backup plan. And that's why yesterday the stock was as flat as can be. But this has come as a bit of a dent to Vedanta's, plans. Let's see how this goes. But otherwise, a bit of a pullback for the stock, I think.
Okay, well, the other stock that we are watching this morning is Car Trade. Now, the company is in focus. It made an acquisition yesterday. It bought OLX India's auto business, Sobek Auto, for 537 crores. Now, OLX India, as we know, OLX globally has been looking to, get rid of or move out of their auto business across the world. And they were looking to sell their auto business in India as well. And now Car Trade has bought that. Sobek Auto runs an automotive digital platform and a classified internet business. So it's pretty much the same business that Car Trade does. It will bring synergistic advantages to Car Trade. Now, if you look at the turnover as well of Sobek Auto, in the last 3 years, the turnover has gone from 550 crores in FY20 all the way to 1110 crores in FY22. So it's been a pretty steady business that they're growing. And I'm going with green for Car Trade today.
Okay, some more stocks on my list. One of them is Nazara Technology. And that's because the company yesterday in a board meet has announced a fundraise. They're looking to raise a maximum of 750 crore. Remember, Nazara Tech has also been very acquisitive across its various lines of business, particularly their sports subsidiary Nodwin. In fact, for the Nodwin business, in May, the company had announced a fundraise of 230 crore. And even the cash on the books, because it generates cash. It may not generate big profits, but it is, cash generative business. The company's cash on the books is 628 crore as of Q4. And now they're looking to raise another 750 crore rupees. I suspect it would be for acquisitions. Tata Communications is the other one that we're looking at. The board approved the acquisition of the remaining ownership in Oasis Smart SIM Europe, SAS. It's a French-based company. It was already a subsidiary of Tata Communication. They had a 58% stake. From 58%, now they will be holding a 100% stake. And the total amount that they will be paying for increasing their stake and, to 100% will be $12 million. So that's a little less than about 100 odd crore rupees.
Okay, well, there's a lot of developments in the defense space, and Parikshit, my colleague, has been tracking a lot of them. The sources say that the Defense Procurement Board has approved a proposal to buy 26 Rafale fighters for the Indian Navy, and there is a proposal to also acquire some submarines. Parikshit is joining us to talk about that, and of course, we'll tell you about the stocks that could be in focus. Parikshit, morning.
Well, yes, Mazgaon Dock will be in focus. Remember, the U.S. had signed a Navy repair agreement with Mazgaon Dock. So, again, now we will see an agreement during the Prime Minister's visit where a deal for 3 submarines, 3 Scorpion submarines is likely to be signed, and these will be manufactured by Mazgaon Dock Limited. Now, this is a continuing order because earlier also submarines in the same class have been manufactured by MDL. The bigger deal, of course, will be the deal for 26 Rafale marine aircraft. Remember, the Navy has been considering both Boeing and Dassault Aviation for its fighter jet program. They want to acquire 26 fighter jets, and we believe that the Defense Procurement Board has given an initial nod to the acquisition of 26 Rafale jets, 22 fighters, and 4 trainer aircraft. There will be a final meeting on this on 13th. And this deal could finally go through during the Prime Minister's visit. The Prime Minister's visit to France will be heavy on defense. We also believe that there is a deal for co-development of jet engines between the French company Safran and DRDO as well.
Okay, all right. Thanks a lot for that. Parikshit explains why yesterday Mazgaon Dock as well was flying away. It seems the street had sensed that. Well, Sonal joins us to tell us about chemical stocks. Sonal, some global companies, they're cutting their guidance out there. Could we on Indian-listed companies as well?
Oh, yes, it would, because that is something that has been impacting chemical stocks in general as well. Demand has been lower, and generally prices have also been coming down. Two global companies, they have cut their guidance. One of them is FMC, which is an agrochemical company. They have cut their, or guided for a weak Q2. They said there has been abrupt and unprecedented reductions in channel inventory by customers in North America, Latin America and EMEA, and this has materially impacted volumes for the quarter as well. In fact, they've cut their revenue guidance to $1 to $1.03 billion versus $1.4 to $1.48 billion for the financial year. Similarly, Evonik, which is a specialty chemicals manufacturer, they said that recovery is slower than expected on persistently weak demand globally. Recovery turned out to be much weaker in May and June than what they had expected earlier. On the back of this, Centrum says that Indian chemical companies will experience an export challenge for FY24, something that we've been seeing in their numbers as well. This will impact earnings materially, and that's why both chemicals and agrochemical companies, especially on the export side, will be in focus.
Thank you very much for that. Now let's get to Vivek for some more stocks which are in the news.
Well, good morning. Quite a few stocks to keep on your radar on the back of news flow. First on our list, McLeod Russell, the debt-laden company, has been undertaking various initiatives to go ahead and reduce debt. So now what the company has done is it's gone ahead and entered into an exclusivity agreement with Carbon Resources. This particular company also has a stake as far as McLeod Russell is concerned. So what the company is looking to do is it's looking to monetize select assets. The company says that it will use the proceeds of this particular monetization to go ahead and offer a one-time settlement to its lenders. Talking about PCBL, Phillips Carbon, now this particular company has gone ahead and commissioned the first phase of the specialty expansions program that it had in Mundra. This particular expansion has a capacity of almost 20,000 metric tons, so significant addition as far as the company's capacity is concerned after this commissioning. Watch out for Sangmi Movers. The order wins continue for this particular name. Company has received work orders of over 150 crores. This is from various independent power producers, and the contracts are for an 18-month duration. And lastly, APL Apollo, watch out for this particular name. Some green is expected on the stock. The company has been granted incentives worth almost 500 crores from the State Investment Promotion Board of Chhattisgarh. These incentives pertain to stamp duty relaxation, electricity duty exemption, as well as transport subsidies that the company is expecting to receive.
All right, thanks a lot for that, Vivek. So a handful of stocks that we're looking at this morning, in case you missed out on any of them. Stocks with positive news flow, there's Cartrade Tech, Nazara Tech, Tata Communications, Mazgaon Dock Shipbuilders, McLeod Russell, PCBL, Sangvi Movers and APL Apollo Tubes. While stocks with negative news flow are the entire chemical sector as well as Vedanta, of course. That's going to be the big headline. But we're also going to talk about a lot of the brokerages that are in focus for the day. Rima, what are you looking at?
Let me start with the JP Morgan report. We know they've been negative on the technology space. They've come out with another report on the ER&D companies. The ER&D companies are L&T Technology, Persistent, KPIT and Tata Elxsi, and they reiterate that the slowdown in ER&D spending is structural and not cyclical, which means growth will revert back to the long-term average growth rates. What we've seen right now, this bump in the last couple of years, will not last. The structural slowdown in spends makes the current valuation super rich, which is why they're underweight across the board. On L&T Tech, their target price is 2,500. On Persistent, it's 4,100. On KPIT Tech, target price is for 540. And on Tata Elxsi, it's 4,500. Bharti Airtel should also be on your radar. Now, CLSA has written a note on India's cloud market. They're saying India's cloud market today is $6 billion. It's likely to triple in 5 years to $17.8 billion. Now, Bharti Airtel is also a play on India's growing cloud market because Bharti Airtel is increasing its presence in the data center market. And Bharti Airtel is looking to triple its data center business. So this will drive upside in Bharti Airtel, which is why they have a buy rating. And finally, Macquarie on Concord. Remember, the Q1 volume data is out. They believe it's come in slightly lower than what the street was anticipating. Weak export and import handling volume partially offset by an inline domestic business performance, but Q1 a bit subdued. They have a neutral rating, target price of 620. So that sums up the brokerage calls for the day. Get into a break. On the other side, we'll be joined by our market expert Ajay Bodke to discuss some fundamental stock analysis. Later on, we'll be joined by Ramni Datti, CFO at Teamlee Services.
Welcome back. You're tuned into Bazaar Morning Call. Hope you're having a good morning. Well, for starters, the gift nifty suggesting is likely to be a start in the green. But there are plenty of stocks to discuss. And to help us out with some analysis on that, we have market expert Ajay Bodke, who joins us on the show. Hi, Ajay. Good morning. Thanks so much for joining in. Well, let's talk about the stock of yesterday first, Reliance Industries. You know, we got a double positive that came in, first on the financial services unit as well as on the retail unit. And stripped of that, actually, the Nifty would end in the red yesterday. How do you see the stock, play out from here on? It's closer to around the 3,000 odd mark. It got a couple of triggers as well. Your view in the stock at these levels?
Good morning, Nigel, and thank you for having me on the show. I remain extremely constructive on Reliance. I think after a few quarters of underperformance, I believe that over the next 1 year, one needs to be overweight on Reliance. If you look at the carve-out of the Jio and the way the structuring has happened, I think today you're looking at an entity with roughly 1.5 lakh crores of net worth, 1.1 lakh crores of Reliance holding, as well as around 40,000 crores of net worth. It becomes, on the day one, the fifth largest in terms of the entire financial services space, and the largest NBFC in terms of the net worth and the capital available. The next one, which is Bajaj Finance, it sort of appears puny in terms of the total net worth that the Reliance Jio entity will have. And with Reliance's proven track record in terms of massive scale-up of operations, offering services to clients at great value proposition, as well as its intent of getting into adjacencies like insurance, asset management, wealth management, and a world-class team. We have seen it repeated in telecom and retail. So I think I would, from institutional investing perspective also, I think a large amount of money would, in my opinion, gravitate towards what are currently extremely high valued NBFCs towards Reliance. Let's not forget that entry of Grasim and JSW had led to a PE derating in terms of the current leaders in paint sector. And we saw the same with Adani's entry into cement in case of the leaders in cement sector. I wouldn't be too surprised if the same dynamics were to play out in case of NBFCs also. So I remain extremely constructive on Reliance.
Okay, extremely constructive on Reliance. Ajay, hi, good morning. Got that. Do you see further upsides in names like Tata Motors? I mean, despite the rally we've seen already, brokerages like Morgan Stanley have a 711 target price, which is an additional 15% upside from where the stock is currently at. Are you that bullish?
Yeah. Good morning, Sonia. I think on the autos, if I were to just dwell for half a minute, I think I expect that this quarter, the demand will continue to improve in PVs and two-wheelers. And when I've seen the sales volume of CVs, I think slightly soften. On the two-wheeler side, I think, I personally feel that after many quarters of underperformance, one is seeing the domestic volumes picking up quite strongly, but the competitive intensity of the high end also is increasing, and the exports remain weak. This will be a quarter, Sonia, in which the margin expansion will continue. And I think this will be the 5th quarter on trot that the margin expansion story will play out in case of auto sector due to superior product mix and high utilization levels, plus low raw material prices on a YOY basis, and lastly, easing of availability of semiconductors. Coming back to your question, I think this will be the first year in, I would say many years, 3 to 4 years, in which the first quarter for JLR in particular and Tata Motors as a whole will continue to remain positive. There will be strong generation of free cash flows for the quarter as well as for the full year. So I remain constructive on 2 companies in auto sector, Maruti Suzuki as well as Tata Motors. So these would be my preferred picks in auto sector.
Any thoughts on Titan? Yesterday, Ajay, Titan took a big leg down. There was a brokerage downgrade on Titan. They believe, given the high valuations, the stock rise that we've seen in the recent past, all the upsides are priced in, and Q2 and Q3 could be a lean period because you don't have that many festive dates, which could fuel merit season demand. Thoughts on Titan and, as it's currently placed right now?
I think I would be cautiously optimistic on Titan. The stock sort of, in my opinion, tactically, I think one could take some profits in Titan because as you rightly said, I think the following 2 quarters, the overhang of slowdown in demand will continue to weigh on the counter. However, structurally, I think the story in terms of formalization of the jewelry sector continues to play out, and Titan sort of being the largest and the most reputed player in the sector, I would not be too negative on it from a structural perspective.
Okay.
But Rima, on the retailers in general, I think if I could just add a line out here, I think what is seen for the retail sector in general is that my channel checks are suggesting that the value for money retailers are struggling in the last quarter. I think if you just look at the footwear sector, I think I touched base with a few companies there, and you're seeing that the growth rates continue to remain very anemic, and the end of season sales in case of many retailers, fashion retailers as well as footwear companies, have already started quite in advance. Say for even a company like Page Industries, I think I'm expecting a 10% degrowth in sales for the first quarter on a YOY basis. And companies like Bata, Relaxo, anemic low single-digit growth, 3 to 4% on a YOY basis. Campus around 8%. Metro, I think, should do slightly better at around 12%. Trent, of course, will stand out. So I think retailers in general, one needs to be cautious as you go into the result season.
Cautious on retailers ahead of the earnings season. Ajay, I request you to stay on. We've got the first management on Bazaar waiting by to chat with us. Now, IT hiring is an area of concern. We've seen IT hiring slow down over the last couple of quarters. That's what the IT earnings from large companies have indicated. And that's been the commentary even from companies like TeamLease. For TeamLease, specialized staffing, which is where they house their technology hiring, has slowed down for the last 2 quarters at least. Are there any green shoots there? Are we seeing a pickup in technology hiring? And what about the hiring in other segments like retail, education, FMCG, insurance, BPO, banking? To talk more about it, we're now joined by Ramani Datti, CFO at TeamLease Services. Ramani, you had flagged a weakness in tech hiring in Q1 and Q2, and you were anticipating a pickup in Q2. Can you tell us what's been the situation on the ground? Are there any green shoots in technology hiring? Are the numbers in Q1 better than what we had seen in Q4? And the outlook for the remainder of this year?
Yes. So in terms of technology hiring over the last quarters, having a drop not in the overall, even the number of replacement hirings, the backfills also, at least in the open positions which have been created by way of attrition are getting 100% filled. That itself is a positive sign. So that means the companies have already reached their full capacity, and for any incremental projects, they have to start hiring. So we are expecting the hiring numbers to pick up from end of Q2 or early Q3. But Q1 and Q2 will continue to remain same as what we have seen in the last 2 quarters.
So can you give us a little more details, Ramani? Which are the sectors where you're seeing a pickup in hiring? Is it only in spaces like oil and gas, real estate, where there's a hiring spree? Or are there some new emerging sectors as well where people are seeing a lot of hiring? Also on the flip side, where are you seeing the hiring reduce significantly?
Yeah. Now, first, let me start with where it has reduced significantly. We already talked about IT, where there is a significant drop compared to last few years. The second segment is the startups, the new age emerging companies like edtechs, fintechs. I think that's largely driven by the fact that they kind of ran out of their funding, and the hiring also has slowed down. Except for these 2 segments, we have seen very positive hiring trends across all other industries. The top ones are telecom, BFSI, FMCG, FMCD, manufacturing, engineering, pharma, across all these segments. So we are seeing the hiring number consistently going on quarter.
Okay. So those are sectors where we are seeing pretty good hiring. Can you give us an indication of the rural areas, tier 2, tier 3 hiring versus tier 1 hiring? I remember reading the Naukri Jobs Peak Index, Ramani. It came out for the month of June, and they indicated that even metro hiring is slowing down. Up until now, we thought that urban demand is looking up. Rural has been weak, at least on the consumption side. On the hiring side, can you give us the rural versus the urban hiring trends?
Yeah. So let me break it up into IT and non-IT. As far as IT is concerned, there is a slowness mainly in metro cities. Again, companies coming under cost optimization and margin expansion pressure. So they are kind of hiring more mid and senior level people in tier 2, tier 3 places. The metro city hiring has come down in IT. Whereas on non-IT side, still a large number of hirings are happening in tier 1 and tier 2 places. While we have expected more numbers to pick up in rural areas, if you take BFSI or FMCG, FMCD, manufacturing, as of now, those numbers have not yet been picked up. We are still seeing large numbers in non-IT segments still happening in tier 1 and tier 2 cities.
Okay, that's interesting. So tier 1 and tier 2 cities, you're seeing large numbers in the non-IT space. Got that. I wanted to understand a little bit about your own business on the operational side. Is there any scope for improving margins further? You were on a cost optimization plan as well. How is that working out, and what do you think the margins could improve to over the next 1 to 2 years?
Yes. So we are focusing a lot on our cost optimization and enhancement of productivity of our core employees. And except for the employee hike impact, the annual hikes which we have given in this quarter, so there'll be a consistent margin expansion happening sequentially from here on. And that impact we have already called out and quantified in the last quarterly call. So since we are in a silent period, I don't want to comment on the specifics of those numbers.
Okay, Ramani, we'll leave it at that. Thank you very much for joining in, and look forward to chatting numbers with you when the Q1 numbers are out. Before we slip into a break, let me quickly tell you what's lined up in the next half an hour on the show. We will be joined, Anuj will be joining in to give us the market setup, and we'll also discuss the technical trades with our experts.
Welcome back. Well, the GIFT Nifty is suggesting a 60-point gap up. Remember, yesterday we ended in the green, but that was courtesy Reliance Industries. Today you'll require the other components of the Nifty to perform. Well, we have Ajay Bodke who's still with us. Ajay, I wanted to ask you about the Vedanta Group companies. You know, earlier they were talking about this semiconductor plant that they had. It was going to be done from the parent, that's Vedanta Resources. Now things have turned around. They've got these two entities, both into the listed entity. And the partner, the JV partner as well, as pulled out. How do you approach the stock, Vedanta Limited, at around 280 rupees? Now, going by the stock price movement, the street seems to be thinking that there is a backup plan, because otherwise the stock would have been under pressure yesterday. Your take?
I think, if I'm not wrong, the company has indicated that they are in talks with another technology partner. And very soon they will be putting an application along with that partner. And I believe so has Foxconn. Foxconn also has indicated that they might tie up with some other partner. I think this has come as a surprise for many investors because the capital requirements, I think, for this project are humongously large. And with the group already stressed in terms of their repayment abilities over next few quarters, I think it will be very difficult, I think, for many investors to digest the fact that such a large project is coming into this entity, and that too quite abruptly. So I think I'd be worried about venturing into Vedanta at the current juncture. I would rather wait and some clarity emerge about the exact structuring for this massive project that they would have in mind, what kind of equity would they put in, and what kind of payback they're expecting for this project. Because these typically are very long gestation projects. And this is, from the group perspective, I would say, not the opportune time to commit such a large capital in this entity.
Okay. In fact, in the last 6 months, while the markets have zoomed quite a bit, Vedanta has lost about 10 to 11%. So I guess that caution is well taken and on board by the street as well. Just stay on, Ajay. We'll come to you in a bit. Anuj is joining us now for a quick trade setup. Anuj, this morning things are looking good. The Dow is well in the green, but what's the sense that you're getting?
Morning, Sonia, Nigel, Rima. Well, you know what? Yesterday's market was very interesting. I describe it as that Salman Khan movie, Ek Tha Tiger. Problem is, Ek Hi Tha. 2,500 crores of delivery buying in Reliance. And if you were to take a look at the contribution plate yesterday, Reliance contributed 78 points to Nifty, and Nifty rallied 22 points. So, X of Reliance, of course, things were not that great. 52-week high for Reliance, and shown signs of getting back to its lifetime high. I mean, there's some momentum, serious momentum. But X of Reliance, if you look at the market, there's been some weakness. The mid-cap index has corrected 1.3% and small cap has corrected 1.4% from the highs. Now, a few days back, I had presented a chart about how the market was overstretched and how it needed some cool-off. And that's happened now. Now, look, this is Nifty. This is a 10-day exponential moving average. This is a 20-day exponential moving average. And this is the period I was talking about when the market was extremely stretched. Now, what has happened is that the moving average has obviously moved up and index has consolidated over the last 2-3 days. In fact, it's more prominent in the Bank Nifty. If the Bank Nifty's chart is also ready, you will notice that there it is. What the correction has done is it's got it right back to its 10-day exponential moving average, which is where it normally takes support. So at least the stretching part is now getting more or less done. That's good news if you're a bull. Now, in terms of what to watch out for today, today is the Fin Nifty weekly expiry. The last 6 Fin Nifty expiries, the last 6 Tuesdays have been really good for the market. On an average, and this is from day's low, Fin Nifty to close, on an average, there's been about a 150-point rally, if you can see. And I'm not even taking days high into account. I'm just taking from days low to days close. The Fin Nifty has done really well. Today is interesting because today is the last time HDFC will be part of the Fin Nifty expiry. From next week, that won't be. So, interesting days lined up. Now, we've discussed about Reliance. The other two big sectors are banks and IT. What's happening over here? IT is showing some signs of nervousness. Today, there's a JP Morgan report as well. Last week, I was talking to Samir Arora. He was still quite negative because this quarter, remember, was the peak banking crisis in the US. And a lot of IT companies have that BFSI exposure. So maybe, you'll see some of that fall. Good news is the stocks are falling ahead of the earnings. HCL Tech has fallen 6.5%. Wipro has broken the 200-day moving average. TCS is very close to breaking it. Infosys has shown some relative strength, but Infosys had fallen earlier, of course. And now coming to banks, I think that could be the clinching factor. My sense is HDFC Bank is very close to another bottom. It's fallen about 6% from its highs, and whatever MSCI related selling has to happen, I think will get done today or tomorrow. So it will start trading a single entity from 13th. So I'll keep an eye on the HDFC Twins, the mid-cap and small-cap index, and of course, Reliance. That will be the factor to watch.
Okay, all right. Thanks a lot for that, Anuj. Well, let's move on. Let's get in our technical experts. We have Mitesh Thakkar as well as Shrikant Chauhan, both of them who join us to give us their technical strategies for the day. Good morning, gentlemen. Thanks so much for joining in. Well, Mitesh, you go first. How do you approach the index today? The GIFT Nifty suggesting a gap up. If we do start off 50, 60 points higher, how do you approach the index first?
Yeah. Good morning, Ali. So, I've been advocating that the markets will consolidate probably between 19,500 to about 19,200. There is some pivot at 19,300 as well. But I think my assumption is that the range will be about 300 odd points. Today, you will see possibly a gap up of 50, 60 points, suggesting that you might open closer to about 19,420, 30 levels. And as we get closer to 19,500, my idea would be to take profits on the long positions. Around 19,450, 470 might attempt a short by buying put options for the next month with a stop about 19,510. And in case that works out, then we'll try to cover the put options positions or book profits there once the market kind of comes closer to 19,300 to 200 range. So basically deploying range bound strategies on the indices.
Okay, well, Shrikant Chauhan is also joining in. Shrikant, do you think the upside momentum is sort of waning a bit? And what is the expectation for today? What kind of levels are you watching out for on the index? And while you're at it, even tell us about individual stocks.
Yeah, good morning, Sonia. Good morning, Nigel. I think, the markets are going to consolidate because if we go through with the FIS activity, then they bought nearly or more than 20,000 crore in last 10-12 days. So yes, after rallying almost 1,000 points from the lows, most of the time the market consolidate, and I think it is consolidating. But one thing is very clear that till the markets are not crossing 19,530, which is the highest point of the current rally, we are going to see more and more stock-specific activity. The action is shifting towards large cap companies. And in this correction, if we see any large cap companies falling to their important support areas, then I think the buying should emerge. Yesterday, we saw good amount of activity in Reliance Industries, ICICI Bank, and some metal companies. We are expecting further more activity in all these companies. But for index specifically, if there is any correction because of any reason, then close to 19,200, there is a room for creating any contra trade of going long. But at these levels, we need to be more and more stock specific. For the day, we are specifically focusing on metal companies again because the activity was over and above based on their price and volume performance. Tata still looks good at current levels around 115 with a target of 120. We can keep stop loss at 112. And the other stock which we like is from the auto companies, and that is Escorts, which is currently around 2280. From here, the stock can move to 2375, and we can keep stop loss around 2340.
Okay, all right. Thanks for that, Shrikant. Mitesh, you run us through your picks for the day, though.
Nigel, I have a mix of buys and sells. So on the buying side, a couple of metal names. JSW Steel is a buy with a stop at 792, targets of 840 here. Steel Authority is a buy. Keep a stop at 88, look for targets of 95. A sell on Coforge with a stop at 46.75 for targets of 44.50. And IRCTC is a sell with a stop at 628 for targets of 5.
Okay, thanks a lot for that. Well, let's take a quick break. But on the other side of the break, we'll be back in a bit. We'll have the pre-opening rates, and also Peter Maguire, the CEO of Exem Australia, will be in to discuss the big trends that are emerging in the metal space, all that's been happening in China and the repercussions of that in the metal universe. More on that coming up in a bit.
Welcome back. Yesterday was a session of consolidation for our markets. This morning, the GIFT Nifty is suggesting a bit of a positive start, but it's the Fin Nifty expiry, particularly for the Nifty Bank. It's going to be important to track the last one when HDFC Limited will be trading. Remember, the record date is 13th of July, so you can trade trade HDFC today and tomorrow. Manoj Muralidharan, VP Derivatives at Religare Broking, is with us on the show. Manoj, first the setup.
Good morning, Rima. Rima, I guess the most important thing, at least in the data that we have seen yesterday, would be an option sell figure of almost 25,000 odd crores. Now, I believe that when the expiry started from June to July series, and after the Nifty crossed the 19,000 mark, a huge amount of call buying in all the style, right from 20,000 to 20,100, even for this weekly expiry, that must have happened. So yesterday, if you see, the open interest has gone negative for major strikes. Even a 19,900, almost 1 lakh has been gone negative. So I believe huge call buying which has happened in the last, let's say, 3 to 5 odd session has been squared off, or that position has been squared off. And even on the future side, there is good amount of short covering, almost 1.5%. Nifty is in a range, but then we believe the spot basis, the resistance would be in the vicinity of a 19,500 odd. So 19,420 to 430 today becomes a good level to go long with a target of almost 19,530. So this 100 points is where we believe the Nifty might be trading in, and that is a better trade to do using a 19,400 strike call options. Stock specific, we look into stocks where there is delivery buying along with a good momentum volume weighted average price buying. So we believe that Tata Chem would top the list. We advocate buying that in the cash market somewhere close to 985 with a stop loss of 970, and a target somewhere close to 1,020 to 1,025 on that. From the FMCG basket, we like Britannia. The stock is seeing good delivery buying, and we expect that 5,210, roughly around 5,200 would be the target. Now you get it closer to 5,020 to 30. That is where you buy that 49.70 as a stop loss on the stock.
All right, thanks a lot. Appreciate your thoughts, Manoj, and have a good day. That's Religare Broking. By the way, the GIFT Nifty is indicating that the start will be well in the green, and the pre-opening rates are settling much higher. So don't be surprised if you see a big move on the index this morning. The Nifty is settling with a gain of about 100 odd points. I don't know if that's actually going to play out, but that looks like a pretty smart opening, led by, surprise, the IT names, HCL Tech, TCS. But we'll wait by for these rates to adjust. Some of the leaders of the market, Reliance, Tata Motors, continue to inch higher. And some metal stocks also doing pretty well. So let's get Ajay Bodke back on board to give us one last view before we let him go for the day. Ajay, this is kind of like an open check question, right? If someone wants to invest in the market, has missed out on the run up until now, what are the 3 or 4 large cap or maybe even non-index large cap names that you would still recommend?
Sonia, I think Reliance, HDFC Bank, where I'm expecting a 20% growth in profits for the first quarter on the back of 26% growth in the NII. These two certainly would form, and Bharti Airtel. Now, in case of Bharti, I think as one of your colleagues mentioned, I think the expectation is that the cloud market should triple to around $18 billion in 5 years' time from $6 billion. And the company has been, over last few quarters, boosting its cloud capabilities with a large number of growing partnerships. So I believe that I would be surprised if Bharti price could touch around, say, 1,100 rupees over a next 12-month perspective. So these three would be my large cap picks. On the mid cap picks, I think I continue to remain positive on the luggage sector because my channel checks are essentially suggesting that the demand remains strong. Also, the competition from the unbranded sector continues to remain weak. And one is seeing a healthy trend in terms of domestic and international air travel, demand for hotels and tourism. And that is actually, a direct indicator of a strong sort of, underlying demand in luggage sector. The marriage season also has turned out to be quite good. So I think Safari, I'm expecting that's my, I prefer Safari over VIP. Safari, I'm expecting around 18% sales growth in the current quarter. The margins will be around, say, 17% odd. And VIP will turn out slightly weaker in terms of top line growth, around 12%, but the margins will stand up at around 18.5%. So I think luggage sector, and lastly, I think PVC sector, pipe volume sector, I think, that's again where I'm very positive, Supreme and Astral, because I'm seeing PVC prices have declined. I think, and that is sort of, will play into the volume growth for the PVC sector. Plumbing pipes, agri pipes, demand remains strong. But on a quarter-on-quarter basis, the margins could come down simply because the companies have undertaken price cuts because the raw material prices also have come down. So these sort of, are the areas that I would like to to concentrate on.
Okay, all right. Ajay, thanks a lot for joining in and waiting by as well, discussing all those stocks. Wishing you a good day ahead, Ajay. Look forward to having a chat with you rather soon. Well, before we get to the next discussion, which is on metals, just keep an eye out on Vedanta. The pre-opened rates, the stock has reacted very, very negatively, I think, to that news that Foxconn is pulling out of that JV that they early signed up for. So the stock is down close to 4.5%. Let's see what the actual rate comes in at. But at least in pre-open, there appears there's more amount of sell orders. But let's focus on the metal space. It was buzzing yesterday. Remember, China's producer prices fell at their fastest pace in over 7 years in June. We are now joined by Peter McGuire, the CEO at XM Australia, who joins in. Hi, Peter. Good morning. Well, metals was shining bright yesterday. The hope is that we're going to be getting a stimulus package coming in from China. Are you factoring in that? And if yes, any quantum you're looking at?
Well, good morning. I think a couple of things. Greetings from Sydney. Yes, absolutely. As far as China and the stimulus package and to try and, kickstart and re-engage their property sector and the overall economy, the domestic demand. So, yes, it was an outstanding day as far as yesterday. And then where we're sitting at the moment, I'm keeping a very close eye on aluminium, looking at copper. And overall, I think there could be a nice move to the upside over the next couple of months if this, if all this momentum starts to gain a little bit of traction. But of course, we do need consumers buying these finished goods. Maybe Chinese demand internally, and of course, an export-driven economy.
All right, Peter. So you're factoring in a stimulus coming in, right?
Well, I think you've got to. I mean, when I read the articles, I take on board what they're discussing, and I won't be surprised if they look at some form of stimulus. Absolutely.
Okay. All right. So if we get a stimulus coming in there, you have a weaker dollar as well. That obviously bodes well for commodities. How do you approach it? What's your preference between ferrous and non-ferrous?
Well, they're very good when you're thinking about ferrous and non-ferrous. I keep a close eye on where we run first off as far as copper to give me an overall demand picture. And if that starts to tick up, I mean, when you're looking at iron ore consumption, it's been extraordinarily strong, and coal into China. So the growing demand in that sense. And I just like to keep an eye on what's happening on copper, give me a barometer as far as domestic health and global health, and then take it from there and look at, what standouts. So it's maybe a little bit early to call for, which markets are going to be stronger than others. But at the moment, I look at zinc, I'm looking at tin, and I still think, that composite of those metals is a nice way to focus.
You said that iron ore consumption has been very strong and you're seeing further upsides there. In the near term, say the next couple of months, what kind of upsides are we looking at, not just for iron ore, but for a couple of the other metals that you spoke about?
Well, I'm looking at it probably through a lens that may be a little bit tainted with, look from an Australian perspective, export driven from the northwest parts of Australia. March, I think, and April were standouts. They were nearly, I think, at record levels. So that's been a very, very nice supporting mechanism for our Australian miners. Now, other metals, of course, there's been an overall across much of the sector, there's been underinvestment across many of those particular many particular mining segments. So I just want to see where demand is, what happens as far as continuation for US dollar. Do we see it back under 100 for that US dollar index in the short run? Or is it going to bounce from here when we get, another rate rise on the 26th of July? So the jury's out as far as dollar, but I think it should be an exciting time for across those metals.
Okay, all right. Any levels you could give us on any key metal that you're tracking that you expected to head in that direction?
Well, I think copper, it's currently just under 8,400 a metric ton. That's US dollar, so I won't be surprised if this stimulus comes in. You have to be saying 9,000 is achievable in the short run, maybe over the next, 6 to 8 weeks. I'd like to see that sort of number, and that will lift all boats. That's why I'm keeping a close eye as far as the copper side of things.
Okay, all right. Keeping a close eye on copper. Thanks a lot, Peter, for joining in and giving us a quick take on what's happening with China's stimulus, further stimulus expected, and all of that impact that will have on the metal space. But let's come back to, tracking equities now. The Nifty is indicating a good start, 70 points higher, led by a lot of the auto stocks, Tata Motors, Bajaj Auto, Apollo Hospitals as well in the green at the moment as well. And then you have something like a Power Grid. TCS also hanging on at that 3,300 level. But what's the momentumizer stock of the day, Rima?
Well, you have two of them, Inox Wind and Inox Wind Energy Limited, IWEL as it's called. And both these stocks were on fire yesterday. This is the pre-opening rate. Let's pull up the yesterday's rates. Inox Wind was up 15%, while Inox Wind Energy was up close to about 8%. Remember, there was a merger announced between these two group entities. It was announced a month back, and since then, these stocks have seen a rally of close to about 35 to 40% and now trading at fresh 52-week highs. While the stocks have been on an up move for the last couple of days, yesterday the kind of turnover it's seen is much higher than what it saw over the past few days. So yesterday's turnover, and I was checking the NSE data, on Inox Wind was about 180 crore rupees, which compares with the last 10-day average of about 30 crores. So, 6x higher in terms of turnover. And even for Inox Wind Energy Limited, IWEL, the turnover yesterday on NSE was about 31 crore, significantly higher than the prior 10 days. So, yes, the stocks have been on an up move over the last 10 days, but yesterday's surge came in on very large volume. So, we're going to be tracking these two names very closely. But let's get back to, the markets. 5 minutes left before we open up for trade. Expected to be a good start after a bit of a shaky session yesterday. Mitesh is here with the 9:10 call. Mitesh.
I'll go with the buy on JSW Steel with the stop at 792 for targets of 840.
Okay, all right. Thanks a lot for that, Mitesh. Well, I'm tracking Vedanta Limited, and in pre-open, I think the stock is now settled down with the cut-off closure around 2%. The problem is that over the weekend, they said that they're going to be bringing these two entities were dealing with the glass panels as well as semiconductors into their listed fold. And they had that partner, that's Foxconn, that was with them. Now, yesterday, the news that came in said that, in fact, Foxconn is actually pulling out of the JV, so they'll have to go solar. I wrote to Vedanta Limited. They said they're still very much committed to the semiconductor unit, and they're scouting for new partners to go ahead with it. They've also given a couple of specifications out there with regard to the 28 NM as well as the 40 NM, and they believe that they're going to be successful in both these two. What do you track from here on with regard to Vedanta Limited? One, what is the total capex outlay? Remember, the last time they spoke about this JV, they were talking about $19 to $20 billion. That would amount to around 1.5 lakh crore. How do they fund this is going to be very, very important. Second up, you'll have to see that how does it impact the current business? Because, they have been paying out big dividends as well. The cash flows will not be enough to fund such a big capex. So that will be important. And the new partner, if any, we'll have to wait by to hear out from them as well. So that's going to be important. For the time being, though, the street a little bit disappointed that they're bringing this in their fold. And then the big partner out there, Foxconn, is pulling out as well.
Okay, so Vedanta is the big drag over there. But Mitesh, just before the markets open, we have a couple of minutes before the markets open. From the top auto stocks that have been gaining quite a bit of ground, any stock where you see an incremental upside? Even this morning, Tata Motors, Bajaj Auto, all trending in the green?
Okay, so I think the one on the radar is Hero Motors. I think with that news, I think we saw a good rally and then a kind of cool off in the last couple of days. But I think it's heading towards the all-time highs of 3,300. And this time, I suspect it might even cross to head towards 3,500 plus. So very, very positive over there. That about Tata Motors and Bajaj Auto both look good. But in the short term, I think, they have stretched a bit. So Tata Motors, I would want to buy it closer to about 590, 585 zones if I get it. And I think the targets are, of course, much higher from here. Similarly, for Bajaj Auto also, I think a mild decline or a pullback would be an entry.
Okay, all right. Thanks for that, Mitesh. Well, let's just stay with that Vedanta story. An exclusive conversation with CNBC-TV18, the Union Minister of Electronics and IT, Ashwini Vaishnav, said that both Foxconn and Vedanta were fully committed to India's semiconductor ambitions. Meanwhile, the Minister of State for Electronics, IT, Rajiv Chandrasekhar, also said that Foxconn's decision to withdraw from the partnership with Vedanta would have no impact on India's semiconductor fabrication goals.
Okay, well, let's move on. We have Sonal joining in now to talk about the chemical sector and why that should be on your radar this morning. Sonal, over to you.
Thank you so much for that. Well, chemical companies, they'll be in focus. That's because a lot of global chemical companies, they have issued profit warnings. The recent one being FMC, which is an agrochemical major. They speak about abrupt and unprecedented reductions in channel inventory across most of the geographies, be it North America, Latin America and EMEA as well. This has materially impacted volumes this quarter as well. In fact, they've gone ahead and slashed their revenue guidance to $1 to $1.03 billion versus $1.5 billion earlier. The second one is Evonik, which is a specialty chemical manufacturer. They say recovery is slower than what they had expected on persistently weak demand. Recovery turned out to be much weaker than what they had expected earlier, and it was lower in May and June as well. Centrum says that Indian chemical companies will be experiencing export challenge for FY24, and this will impact their earnings materially. That is not in last couple of weeks itself. There have been a slew of profit warnings. For instance, Clarion said they expect 17% and 10% decline in their revenues on a YOY and on a sequential basis. Demand continues to be impacted in key markets in both their care chemicals and additives business as well. Lanxess AG said that nearly all industry markets are impacted by weak demand and destocking, and profit warning in neighboring industries and chemical industries feel like layman too, because these are the prices they have not seen in a long time. Even Olin says there's challenging demand environment for both VCM and epoxy resin, which are the two major products. So across the globe there are profit warnings, and of course that will impact the export market for Indian chemical majors.
All right, thanks a lot for that, Sonal. Well, we're just heading into the market opening, so let's just focus on that. About 10 seconds left. Remember, yesterday the Nifty consolidated a bit, came off its highs, closed flat. But this morning looks like it's going to be a different picture altogether, because both FIs and DIs bought in the cash markets, and the pre-opening rates also indicated a strong tick. There we have it, a rock-solid opening this morning, 70 points higher now on the Nifty. The sensex is up about 240 points, followed by the Bank Nifty, which is up 113 points. So straight off the bat, a very strong opening. The market, of course, is choosing to buy every dip, and it is led by a lot of these rate sensitives itself. So whether it's autos which are topping the charts yet again, there's Tata Motors, Bajaj Auto, Maruti, all in the green. There's HDFC Life, that is the big Nifty gainer as well. Apollo Hospitals is up about 0.7%. Eicher Motors is up 0.7%. And then you have FMCGs, so something like a Nestle, Titan are all in the green right now, holding on to gains of about 0.5% plus. Reliance continues to bat for the bulls. There was big delivery buying yesterday, and that continues. I mean, the buying continues this morning as well. Bharti Airtel up in the green, so telecom is doing pretty well. And then you have a couple of banks. The banks are actually batting for the bulls this morning. Axis, Kotak, IndusInd. So across the board, there is definitely a lot of buying interest. You can see it in the advance decline ratio too. So that is well in favor of advances now, 1900 stocks. So crackling market. Reliance, by the way, fresh record high. Bharti Airtel fresh high this morning. A lot of tire stocks like Apollo Tyres sitting at fresh highs as well. So there's so much to celebrate for the bulls.
Well, that's right, Sonia. But, you know, on the flip side, a couple of stocks are reacting to the global cuts that we saw from a couple of big agrochemical players. UPL is down close to around 2%. PI Industries may not be impacted that much, but that as well is down close to around 2%. Remember, Sonal told us earlier that two big players have gone ahead, FMC, they've gone ahead and cut their guidance. On the back of that, both these two stocks are under some pressure, both of them taking a bit of a knock. Vedanta, Foxconn has pulled out of that JV. They're looking for a fresh partner. For starters, at least the stock is down close to around 2%. Vedanta says they're committed to this particular plan that they had set out, semiconductor plan, and also they'll find a new partner, so the street will wait by for that. But the stock is down close to 2%. KPIT Technologies, JP Morgan, they continue to be a little bit skeptical about these ER&D players, in terms of the demand outlook and how it plays out. And at these valuations, they're a little bit cautious, so that stock is down close to around 3% odd. On the flip side, you have a couple of big gainers. Tata Communications on the FNO pack is up 2.5%. Max Financial as well is up close to around 2.5%. On the Nifty, a quick word out there, 19,435. That's closer to where the opening was at. You need to hold above those levels. There was a bit of a dip of around 20-25 points odd. That's got bought into. You needed to trade above 19,435, which incidentally is yesterday's high of the day. If we can trade above that, well, we'll brace ourselves for a bigger up move. Rima, what else?
Well, McLeod Russell is moving up quite smartly, so that's up close to about 7.5%. Remember, the company yesterday in its board meet has announced that they are entering into a mutually exclusive period of talks to negotiate with Carbon Resources to monetize their assets. McLeod Russell very recently was in insolvency, so they want to monetize their assets. Until the 28th of July, they will be holding mutually exclusive talks with Carbon Resources, and that has spurred an up move in the stock. It's currently up close to about 7.5%. There is some news coming through on APL Apollo Tubes, where the company has got some incentives, so the stock has opened up 3.5%. Philips Carbon Black, small company, but now currently higher by nearly 3.5%. Tata Communications in the F&O pack is one of the big movers, and Cyan DLM, it was up 58% yesterday, and it's followed it up with another 1% gain. Broadly, you are seeing some strength in the insurance companies. So whether it's HDFC Life in the frontline pack, or it's, I think the last time I checked, ICICI Pru Life was up close to about 1%. There is some strength in the insurance names. Apollo Hospitals is looking quite smart.
Just a couple of stocks. Cartrade is the one that's really surging now. So 15% higher on Cartrade after that acquisition. Cartrade has, of course, been struggling a bit in their business. And now with this acquisition coming on board, there are synergistic benefits of Sobex. So let's see how that shapes up for Cartrade. It's 14% higher. The other stock I just want to profile is Hero MotoCorp. It's under pressure this morning while the market is doing well. Yesterday, we put out an update that the Bajaj Triumph bike, Speed and Scrambler, have seen 13,000 bookings in less than 5 days of the India launch. And, that got Bajaj Auto to a new high. This whole competition between the two-wheelers continues in the premium end of the market. So Hero continues to be under a bit of pressure on the back of that. But let's talk about the markets now and how to approach it. Rahul Chadda, the Chief Investment Officer at Mirae Asset Global Investments, is joining us. Rahul, hi, good morning, and thanks for being with us on the channel. Has the time come to take some money off the table, or do you think that we're just getting started as far as the up move is concerned?
Okay, so we've always liked the India story, more so post this COVID recovery which has happened, and it's done well for us in our portfolios. Our regional funds are still kind of an overweight India. But in recent, I would say, days, we're taking some money off the table through, particularly in the Indian mid caps. Look, these names have run slightly ahead of fundamentals. Numbers are good. Overall, medium-term story is good. But yeah, I mean, the price momentum has been slightly on the excessive side. So one would be tempted to take some money off the table here.
Which pockets of the mid-cap space makes you a bit uncomfortable, Rahul?
Absolutely. So if we see, let's say, over the next 6-9 months, what is going to happen is Fed is again going to go back to contracting the balance sheet, which is unlike what happened from Feb onwards, where Fed expanded the balance sheet by close to $500 to $600 billion. We'll see a couple of more rate hikes coming. And I think that is going to put some pressure on rupee. What we're going to also see is domestic liquidity get tight over the next couple of quarters. Already the differential between dollar loans and local domestic rupee loans is a record low, and we see more corporates kind of repaying their overseas loans. So what we are expecting is in the next couple of quarters, as domestic liquidity gets tight, things would slow down. And obviously in line with what's happening globally with the Fed's balance sheet, multiples should contract.
Hi, Rahul. Rahul, we are bracing ourselves for earnings season, and IT stocks will kick-start that. How are you approaching the IT themes? I recall a few months ago you were in the camp that said that maybe for a longer duration you could buy some of these stocks and expect maybe high single-digit returns out there. Given that global setup is a little bit gloomy, how do you approach them from here on?
So this quarter obviously is going to be a soft quarter for IT names, but if the view is that a recession in US is a shallow recession, probably over the next 6 months, it would be a good time to accumulate these names. Look, we are also looking at China, and from what it looks like over there with the amount of balance sheet expansion PBOC is doing, it's highly likely that renminbi weakens. And historically, we've seen rupee and renminbi have very strong linkages. And what we discussed before in terms of interest rate differential between, US and India, highly likely that the Indian rupee also weakens. So from that perspective, IT may be a good hedge. And if one is willing to take a 12-18 months view, the view is that things improve in the US and growth momentum comes back for the sector.
Okay. I do want your thoughts, Rahul, on all that's been happening in the two-wheeler space, especially this, war in the premium segment, right? with the Bajaj launch, and then you have the Hero Harley launch as well. Tell me a little bit about whether the market is big enough, the premium end of the market is big enough for both to thrive, or do you think it would be one against the other? And as an investor, how do you approach it now?
Okay. So I think initially the margins get impacted for the incumbent iShares as they're forced to, or they would be forced to add more features at the same price or give more discounts, or they'll see some of their market share go away if they don't do anything. So clearly it's going to be a pressure for incumbent, and which is iShares, and we've seen the stock come under pressure. But eventually over a medium term, which is 3 to 5 years, if you believe in the India story, if you believe in that premium segment growing, I think there is going to be a room for more than one strong player in that segment.
You're cautious on the mid-cap space, where you believe we will see profit booking as liquidity starts, tightening a little more. What about the large cap space? Anything in the large cap universe where you think the valuations have stretched?
In the large cap space, see, if you say what we like in the large cap space, we would like the large private sector banks. To be fair, they've not participated in the rally. Even the SOE banks like SBI, etc., they haven't really participated much in the rally. So I think that is an interesting space. These are names with good CASA franchises. Where one would take some money off the table is NBFCs. We've seen these NBFCs run very hard on this notion of peaking inflation, on the strong disbursement some of them declared. I think one would be tempted to take some money off the table there. Real estate is a space we've liked for last 3-4 years. These stocks have been multi-baggers for us. But again, with this thesis of tightening liquidity, slowing growth, I think temporarily one can take some money off the table in that space also.
Rahul, the one call I recall that, you were in minority, which you got right, as you were saying, allocate a small amount of money to these new age themes. And they played out because the past quarter actually was the best for them. From bombed out levels, they came back. A couple of stocks I think you liked were Nykaa as well as Zomato. What's your view on them now? The bounce came about, big returns came about from those lows that we saw a few months ago. But further upside for these stocks, or would you say it's a small bet I've taken, just hold on to it. Hopefully it pays better dividends.
I think for the market cap, these market caps are very small for the opportunity handled. And like the way you said, these are still 1.5–2% weights in our portfolios. Happy to kind of underwrite these names. Obviously, the gains are going to be much more slower than what we saw in last 3 to 6 months. And I think the ride is going to be a lot more tougher, particularly for Nykaa and fashion, where they have a lot more competitive segment. But at the end of the day, these are good companies. They've shown time and again their resilience, and that's what one is backing in them.
Okay. So overall, you seem to be a bit cautious on the markets now, especially because of the expectation perhaps that there could be another rate hike coming from the US Fed. But so far, if you look at it, these rate hikes have not impacted at least our markets, right? I mean, even if you look at the NASDAQ, it's up 30% this year, hikes or no hikes in interest rates. Do you think that could be the order of the next 6 months, that even if the interest rates continue to move higher, the interest in equity markets will remain solid world over?
So if you look at this rally, see, this rally started from Feb onwards when we had this regional bank crisis in the US, and Fed came in quickly and people realized that, look, there's a policymaker put or there's a Fed put and policymakers will come quickly. And also there were signs of inflation falling faster than expected. And that's where everybody thought, look, you will have easing by the end of the year, growth momentum comes back, and this is the time to add. And now, speaking of inflation was correct. What we are not sure is whether central banks would ease so quickly. I think if you look at the statements which are coming from most central banks all over the world, what they're worried about is inflation being sticky. I think the narrative over the next 6–9 months is these policymakers are doing nothing despite slowing growth. And that is what is going to make markets worried. Markets are going to be worried about slowing revenue growth momentum with not much support coming from policymakers in terms of cutting rates. And that's where things would correct. Valuations are also not cheap. And I think we get better entry points over next 6 to 9 months for structural growth story. We clearly believe that, look, markets like US, India, where we've not seen any excesses investments over last 10 years, are very strong structural stories, and one wouldn't like to buy dips. And within let's say these multi-year structural stories, you'll get these cyclical humps, which we are probably going through now. And those would be good time to kind of take some money off the table and enter 10-15% lower.
Top down over the next 6 to 9 months, Rahul, what's the kind of index correction or time correction price-wise that you're anticipating for those who look at the index very closely?
You would not see much correction in index, to be fair. You will see a 5-7%, not much. I think a bigger pain is going to be felt in mid caps, and I think that's the way it's played out in last 4 to 5 months, where, to be fair, index hasn't really moved much, but some of these mid caps are up 30-40 for the domestic cyclicals. Mid caps up nearly 50%.
Rahul, Bajaj Finance yesterday, the stock was under pressure. It's been a very, very good growth company, high pedigree, but the problem is valuations. And now you'll have a Reliance arm, that's Reliance Jio Financial Services, that will be listed as well. So maybe, in fact, there's more amount of stocks to play it if you want to play this theme. And that's why the stock was under pressure yesterday. Do you think the multiples are at risk? And how do you approach Bajaj Finance from here?
Absolutely. So I think what is happening to Bajaj Finance is very similar to what happened in Eicher Motor. Everybody sees the market cap. Everybody sees the profit pools. This is what is happening in the paint space also. And each of the promoters wants to have a slice of that market cap. And look, 3 years back, it was only Bajaj Finance which is growing. Now you've got all the private banks, ICICI, HDFC, Axis, everybody's growing. So obviously, somewhere the multiples need to adjust for that. At a nearly 270,000 crore book size, a wholesale funded NBFCs when liquidity is going to be tight. Somewhere market is not fully fathoming or discounting the risk.
Okay, all right. Thanks so much, Rahul, for stopping by and filling us in with your take on a whole host of stocks as well as sectors. Wishing you a good day ahead. We look forward to having a chat with you in the coming days as well. Well, time to move on then. PB Fintech. Well, during its recent analyst meet, they indicated they're going to be turning profitable soon. In fact, CLSA, they have an outperformed rating on the stock with a target price of 720 rupees. Mr. Yashish Dahiya, the chairman and CEO of PB Fintech, joins us on the show. Hi, good morning, sir. Thanks so much for joining in. Well, on the net profit front, you have guided that you turn profitable in FY24. Do you stick to that? And then you see the profit number moving to around 1,000 crores in FY27. Just want to reconfirm the net profit number. And also in FY24, what kind of an improvement you're expecting in the adjusted EBITDA? Because a lot of brokers, they're looking at their numbers, they are factoring in a swing of around 250 crores in the adjusted EBITDA. Your take?
No, all of those are correct numbers. So, yes, we will be positive at the PAT level this year. And yes, we have guided that in 27 we should make more than 1,000 crores of profit. And yes, the delta over last year to this year on the adjusted EBITDA front should be about 250 crores. And actually on the EBITDA front, it will be a little higher. It would be, so at the EBITDA level, I believe the difference should be almost 400 to 500 crores of delta from last year.
The adjusted EBITDA front, just to reconfirm this, we got the PAT number out of the way, but last year the adjusted EBITDA number, I think, was around a negative 120 crores. So on that, you're saying a delta of around 400 to 500 crores?
No. Adjusted EBITDA would be about 250 crores. You were correct with that assessment. However, on the EBITDA front, it should be a little more than 500 crores difference from the previous.
Okay. So since you're quite optimistic, Mr. Dahiya, I just wanted to understand what are the growth triggers now for PB Fintech over the next 1 to 2 years? And where does the credit business fit in? I mean, in terms of both growth, profitability, what are we looking at over there?
See, every time we are a contribution positive business, right? So we make about a contribution of 44%. So if our revenues in general go up by 100 rupees, that almost means 44 rupees of contribution. And what that applies is that as long as our fixed cost does not grow faster than revenue, that means there's a flow through to the bottom line. It's a pretty straightforward business. There's not much complexity in it. It's just the growth of the revenue which leads to higher and higher profitability as time progresses. And yes, we should expect, maybe a 600 crores growth in revenue, and that should lead to about 250 crores growth in the adjusted EBITDA level.
Sorry, the reason I asked you is what the growth triggers are is because there is a lot of disruption in your space as well that's expected over the next, 12 to 18 months. Any kind of strategy to combat competition, and what is the plan as far as, what do you see as the big growth levers for the company over the next, say, 12 to 18 months?
See, I think, disruption in our industry is very poorly understood. And the reason I want to say that is for the last 15 years, everybody's been promising disruption in the next 12 to 18 months. But those 12 to 18 months have not come. And I think the 12 to 18 months are not going to come in the next 12 to 18 months either. It's just because I think people don't understand what we do, that people somehow believe something. What we do is a pretty hard thing. It is convincing people to buy health insurance and life insurance. There is no disruption that can make people suddenly buy a lot more health insurance and life insurance. It's about, if you think about yourself, why would somebody spend 20,000 rupees for something that they don't get almost no benefit out of when they purchase it? But maybe one day if they fall sick or if they die in an untimely manner, their family will get financial support. It's a very complicated product. And I don't think people understand that when they believe something very simple is going to, cause any disruption. And as I said, it's been promised for the last 15 years, but we've been waiting. And I don't think we need to wait any longer because I don't think it's coming anytime soon.
Just want to get in a structural question. Over the next 4 or 5 years, can your contribution margin, which currently stands at 44%, as you told us, can it move up or does it stay at these levels?
It naturally moves up, and I'll explain. See, our renewal business, we have two parts of our business, right? There's a core part of the fresh business we do, and then there's a renewal. So the renewal business is substantially more profitable. And so as we get older, our renewal business becomes a bigger and bigger part of our overall business. And that automatically implies that there is a margin enhancement. See, at a very fundamental level, we do a very hard business, which almost nobody else does, not just in India, but nowhere in the world. And that business is badly misunderstood, but it's a pretty straightforward business. Every time we are able to sell a policy, we make a lot of money. And that money does, as we sell more and more policies, we contribute more and more. And
so when you give us a guide, so you've given a guidance of 1,000 crore of a profit number by FY27, right? So with that time horizon in mind, what do you think the contribution margins could stand at?
I think I haven't thought through that in a because 1,000 crore guidance is a very rough guidance. So I haven't really thought through that, but I would hope it will be upwards of 50%. Okay. But let me just explain, right? In the last year, you saw our profits change by 500 crores. This year, again, you will see a very similar change of about 500 crores. And we will be PAT positive. Now, there is no reason that in the next 3 years, you shouldn't see shifts towards the positive. And I think that is really where the 1,000 crore number comes from. It's a very simple calculation. There's nothing very complicated about it.
So tell us the calculation, Mr. Dahiya. You said rough. How does this 1,000 crore profit number come?
Look, if you look at last year, we had 600 crores of ESOP charges, right? In the 2027, that number is less than 100 crores. So you have a 500 crore delta from just the ESOP charges coming in. So we, our core business, even last year was profitable. This year will make about 300-400 crores of profits. So I think we are a very misunderstood story. Our core business already makes about 300, like this year is going to make about 300 crores of profit. And I think it is just because of the inflated ESOP charges that we look like we've been making losses in the past. And of course, there's a renewal stream that grows faster. So I think these are, by most of the analysts now, these are increasingly getting to be fairly well understood numbers. Just our renewal business alone, by a simple calculation over the next 3 years, creates an additional business or a revenue or a contribution, sorry, of about 400 crores. Just that part, right? And it's been doing so in the past also. Last year also it did about 100 crores. So there is nothing new about it. I think it's new initiatives and ESOP charges which confuse the story. And it's okay. I think most of that is behind us.
So, I guess the overarching theme is this whole online insurance space, right, which has been growing quite a bit. And anyone and everyone is trying to sort of grab market share. Just wanted to understand what is your market share currently and how much, of course, you are the market leader, but just wanted to understand how the dynamics are working currently. And what do you think the compounded growth rate of the industry could look like, say, over the next 1 to 2 years?
See, let me try to give you a base story. India's nominal GDP is growing at between 13 to 15% every year. So if we have to even maintain our insurance penetration as a country, we have to grow at about 13 to 15%. Within that, health insurance and term insurance seem to be underpenetrated segments. People need them quite a bit. So they should ideally grow faster than this. Online should grow a little faster than that. There are a lot of things we are doing which should make us grow faster than that. So I think on the whole, a 30% kind of growth for us seems to be fairly normal. But I'm not talking about 2 years or 3 years. I'm talking about a 10-year, 15-year period that this could be happening for. Now, you mentioned competition. I genuinely, and I'm not trying to make this up, I don't even know the name of our competitor. That who is the competitor who's selling health insurance and life insurance in the market from a comparison standpoint? I don't even know who does that. And I don't think that's an easy problem to solve. I hope more and more people do it because that will only grow the market and also make us grow faster. Please appreciate, always competition makes you grow faster.
Right. Just to reconfirm those numbers for this year, Mr. Daya, you're expecting revenues to grow by 600 crores. The EBITDA, adjusted EBITDA swing will be 250 crores and the net profit turns is positive, right? The reason we're asking you, sir, is because there were a lot of numbers that came out. So just want to reconfirm those numbers.
Oh, no, sure. See, our revenue will grow by about 1,000 crores. I think let's wait and watch. But we don't give too much guidance into the future. I think the only number that we have said is we will be PAT positive. Right?
Positive. Oh, all right. And you've given us a few more numbers in this interview as well, which we have taken down. Final question, Mr. Daya.
Don't hold on to them. I could be wrong also on those numbers. But I think the PAT positive will happen. I could be very wrong on any of the other numbers. Don't worry.
But
there are
as
only 3 numbers out, which is 1,000 crore profit in 27, being profitable this year, and in the last quarter being EBITDA positive. Those were only 3 numbers that we put out in a serious manner. Rest, everything is we're just talking, that's all. So don't take them too seriously.
You're aiming to at least have an adjusted EBITDA swing of 250 crores, right? That's the other aim that you have.
That is us conversing. If you come and ask me after 2 years, you said this, then you said this. No, nothing of that sort. The only thing that really matters is being PAT positive. Right?
All right.
To do that, of course, you'll have a few supporting numbers that have to happen.
Okay. All right. Final question that, the street is a little bit cautious on some supply. Tencent, Cloud Europe, BW, they had some stake. I think they had 8% stake and they sold some portion of that. Any further, clarity with regard to whether or not they want to further bring that down? 2% was sold at less than 600 rupees.
The only clarity I can give you is we don't speak to our shareholders in terms of who is selling, who is buying. They are all free to do whatever they feel like. They have their own reasons. I don't think we either get to know that because most of it is done through bankers. They don't, contact us to tell us we are about to sell or anything of that sort. And I think the bankers usually have pretty good knowledge of what's going on, but we don't. We usually find out after the event has happened.
Okay, well, we got our answer. Thanks a lot for joining in. Appreciate your thoughts and all the best for the future. That's PB Fintech. But let's do one thing. Let's take a quick commercial break. On the other side of the break, Itira Davis, the MD and CEO at Ujjivan Small Finance Bank, joins in to discuss the company's business update. We'll put focus on the banking space in our special segment, Quarter Se Quarter Tak. We'll discuss more on that with Pranav Dheeraj Gundalapale of Sanford Bernstein. Welcome back to Bazaar Morning Call. Well, this is Corporate Radar. Let's take a quick look at what's happening with the market. It is doing very, very well. So the last time we left it, we were up about 70 points, and now the Nifty has jumped to 111 points higher. The mid-caps are on a tear this morning, 240 points higher, and there's no stopping the Bank Nifty either. So great going for the bulls. Gives us some time also to talk about the spaces that are moving well. Ujjivan Small Finance Bank gained nearly 40% this year so far. It also reported a very strong set of Q1 numbers. The disbursals went up 22%, and the deposit momentum has been strong as well. Itira Davis, the MD and CEO at Ujjivan Small Finance Bank, joins us now to talk about that. Itira, thanks so much for joining us. So I want to start off first with what the expectation is on the deposit momentum. I mean, the loan growth has been very strong. It's a 30% growth that you've seen. Are these growth rates sustainable over the next couple of quarters?
Good morning, Sonia. It's good to be with CNBC. Yeah, I think the numbers we have seen in the fourth quarter are very good. First quarter is always a bit slow in our business. Second and third quarter looks good, and the big quarter is always the fourth quarter. So when you compare fourth quarter with first quarter, the numbers look slightly different. But if you look at year-on-year numbers, you're right. Our numbers look very good. Our deposit growth has been 44% between first quarter last year and first quarter this year. That's an excellent number to confirm that deposits is the focus. We are seeing good uptick, but there is a slight change in the way the market or the customers are perceiving this. You would have seen across the board, many banks have seen CASA come down, compared to the fourth quarter. And this is something that, customers are beginning to feel that the end of the uptick on the interest rate cycle is getting to an end, and it's good time to lock in fixed deposit interest rates. So there is a movement out of especially SA into term deposits, which we have seen in the first quarter. Now, having said that, I think, interest rates may remain at these levels for a bit longer because inflation is not doing very much. It's continuing to be very strong. So there may be some delay in interest rates turning down. So while we were expecting things to happen in the early second half of this year, it may get delayed further. But nevertheless, the growth in deposits is going to continue to remain strong, and that is our focus for this year.
All right. Good morning, sir. Given this kind of strong deposit momentum that you just mentioned, will it have an impact on NIMs? What kind of a guidance could you give us on the NIMs parameter going ahead?
Yeah, I think, we have anticipated and given a guidance that we will see a slight drop in NIMs from 9.5% where it was towards the 9% level. That is a very conscious move because we are trying to increase the retail deposit base of our book rather than the bulk deposits. So that is a very conscious move. And we've built that, sort of a 0.5% increase in NIMs over into our business model. So despite that, I think the numbers for this year will continue to be good, despite the slight drop in the NIMs.
So this disbursals decline of 12% on a quarter-on-quarter basis is purely on account of seasonality, Q1 being the leaner quarter compared to Q4, which is strong for you?
Absolutely, Rima. That's really the way in which the market operates. And definitely...
It's not that there is any slowdown in the market which has resulted in this drop. It's pure seasonality.
Yeah, no, that's why I started by saying, when comparison should be year-on-year.
So what can you guide, sir, on the disbursements front for the full year? You're mopping up deposits very well. Can you talk about the lending growth?
Yeah, the book, the AUM, which we have guided for, at the end of the year numbers which were released, we spoke about a 25% plus growth in the book. We continue to maintain that will be the trend and that will be the direction for the overall book.
Okay. I just wanted one view on what's happening with the industry as well. I was looking at some industry data if you look at it, the customers don't seem to be growing for the industry, but the ticket size is growing. So looks like there's some evergreening of loans. Just trying to understand if that is the situation. Why is it that although the ticket sizes are going up, the number of customers have not gone up as much for the industry?
Are you talking about the microbanking industry or?
Yes, the microfinance industry, yes.
The microfinance industry, yeah, we have seen a lot more people, a lot more players come back into the microfinance space post the COVID crisis. Now the COVID crisis being behind us, they're moving in. Now ticket sizes, there have been some restrictions or some, conditions which have been put down by RBI as far as the GLG, the group lending model is concerned. So a lot more people are looking now at the individual lending model, which is slightly different. Individual lending is more about people who have been in your customer base for some time, have gone through 2 or 3 cycles, and based on your database are ready to move out of a group structure into borrowing on their own, standing alone. So those IL loans have gone up in the industry, and perhaps that is the reason why average ticket size has also shown an increase. But having said that, this is a growing space. I think as more players come into, or more financiers come into this space, you will see more customers. So look 6 months down the road and let's look at it and see whether this trend has changed.
Okay, so you're saying that the average ticket size has gone up because individual loans are going up. But my other question to you was, are we seeing a lot of evergreening of loans? Is that why the number of customers are not growing for the industry?
I think RBI has made it very clear on where they stand on evergreening. So I don't think anybody which is institution regulated by RBI will look in that direction. So I doubt there may be some evergreening, but definitely that cannot be seen as a trend in the industry.
All right, Mr. Davis, also credit cost guidance. I think you had given up around 100 basis points. You're sticking to that, right?
Yeah, we're sticking to that. The GNPA continues to drop. It's come down by a further 0.5%. So yeah, we are hoping that we'll get towards the 100 basis points.
Got it. All right. Also, quick question, Mr. Davis, on what are the approvals pending for the merger between the two Ujjivan entities? This is important because it appears there is a bit of an arbitrage opportunity as of now. And I think you were pending some approval. Is it due?
Yeah, the final approval is the approvals from NCLT.
NCLT, yes.
NCLT approval, we are hoping will come sometime by the third quarter. Once that comes, obviously we have to do it may even come during this quarter. I'm talking about the requirements. NCLT obviously asks us to do certain things vis-a-vis shareholders. Shareholders have to have meetings, the majority of the minority, and so on and so forth. So all of those may play out into the third quarter. So we are still hoping that the reverse merger will be completed during this financial year.
Got it. Mr. Davis, you told us that there has been a shift by the customers from the savings account to term loans. They want to lock in the rates, as a result of which the CASA has come down. Your CASA currently at 24.5% is, I think, at a multi-year low. At what point would you get uncomfortable with the CASA levels, and would you take steps to improve it? And if yes, what would they be?
Yeah, growing CASA is an important factor. So to that extent, I am already uncomfortable. So we are already looking at ways to increase it and go back to the levels, first to the levels we've seen at the end of the last financial year, and then even push it further. So yeah, that is on our minds all the time. And we are working with the people on the ground to make sure that CASA levels can move up back towards the levels where it was in March, and then beyond that as well.
And you see a further improvement in asset quality as well?
Yes, asset quality continues to improve. We are seeing good collections. It's been, the numbers reported 3 months in a row, it's at 99%. And we are seeing even the arrears collections coming in. So all in all, gradual improvement we are expecting to continue.
Mr. Davis, we'll leave it at that. Thank you very much for joining in. By the way, the markets are surging now at the day's high. It's 19,480, more than a 100-point gain on the Nifty, while the sensex has surged 400 points. Banks are lagging a tad bit. So you've got State Bank of India currently in the red. Muted gains for HDFC Limited, HDFC Bank, ICICI Bank. They're just up close to about 0.25%, and that's the reason why the Nifty Bank isn't participating to the same extent as the benchmark index. The Nifty Bank is up 0.4%, but compared to the Nifty Sensex gain of 0.7%, it's a relative underperformer. But let's get to our special segment, Quarter Se Quarter Tak. Abhishek is here to take us through the expectations from banks this time.
Well, for banking sector, the loan growth is expected to be good. So it has grown at 15.5% on a YY basis. And on a sequential basis, the growth rate is approximately around 2.5%. This indicates that banks are witnessing increased lending activity. So the net interest margin, which represents the difference between interest earned and interest expended, may face some pressure in the near term for many lenders. So this could be attributed to various factors impacting the profitability of the bank. The outlook for net interest margin in the near term is expected to be negative. Around 10 to 20 basis point is a decline in net interest margin that you can expect. The banks are facing challenges in maintaining healthy margins due to factors such as competitive pressure and market conditions as well. The incremental CD ratio or the incremental certificate of credit to deposit ratio in the first quarter has been around 66.5% compared to 93.6% in the same period of the previous fiscal. So this indicates a relatively lower growth in the issuance of CDs by the banks. Private banks, on the other hand, expected to have a strong pro forma business update, indicating that robust performance is here to stay. They are gaining market share in the banking industry. Additionally, private banks are likely to invest in the franchise, which could lead to elevated operating expenses or OPEX for them. The asset quality of the bank is expected to improve primarily due to lower slippages. The deterioration of loans in a particular period is known as slippages, and better recovery efforts that will aid in gross NPA improvement. So banking sector will take measures to manage their loan portfolios effectively. Credit cost, which refers to the expenses incurred by banks in managing their credit risk, is expected to be lower or under control. This indicates that banks are likely to have better risk management practices, resulting in a reduction in cost efficiency with respect to credit defaults. Private banks may continue to invest in the franchise, which could keep the OPEX elevated. PSU banks, on the other hand, are expected to continue witnessing a strong improvement in the profitability and return ratios. PSU banks will experience positive developments in their bottom line, and they are making a progression in their financial performance as well. So based on Kotak Securities estimates, State Bank of India's net interest income is expected to be up 24.5% YOY and down about 3.9% quarter on quarter. Net profit is expected to be up 175% YOY and down about 0.1% sequentially. HDFC Bank, the net interest income growth is expected to be 19.6% YOY and down about 0.2% quarter on quarter. Net profit is expected to be up 23.7% YOY and down about 5.8% quarter on quarter. ICICI Bank, the net interest income is expected to be up 31.5% YOY and down about 1.8% quarter on quarter, while their profit is expected to be up 31.6% YOY and down about 0.4% sequentially. Axis Bank, the net interest income is expected to be up 24.8% YOY and down about 0.2% quarter on quarter, while their net profit is expected to be up 39.6% YOY. In the previous quarter, they had reported a huge loss due to merger of Citi's retail business, so it's not a comparable number. Back to you.
Thank you very much for that. Pranav Dheeraj Gundlapalli, Senior Research Analyst at Stanford C. Bernstein, is now with us to take us through his expectations from the banking sector this time around in terms of earnings. Pranav, morning. This is Rima here. First, top down. Can you give us the big picture on what we should expect from banks this time?
Good morning, Rima. So this time you should still see the continuation of good times with a very healthy year-on-year growth numbers, both from an EPS perspective as well as the income perspective. But on a Q-on-Q basis, I think the gains would be muted. with limited increase in net interest margins and OPEX continuing to remain high, OPEX growth continuing to remain high for most of these banks.
All right. So you're saying that the loan growth is expected to be on the stronger side, right, Pranav? And if yes, what would top the charts in terms of private sector banks for you, for an investor?
Okay. On a year-on-year basis, it still remains high. You have the system growing at 15-odd%. So we expect, most of these banks to report numbers around that range. Now, within banks, the ones focused more on the consumer side would see a stronger growth. The likes of ICICI Axis, which have a greater tilt towards consumer loans, would see stronger growth. And so will the smaller banks, which are even more focused on the retail segments. So banks with more retail would see stronger growth. Whereas on the deposit side, the pressure would ease or would have eased last quarter with an increase in liquidity. On a Q-on-Q basis, the deposit growth was actually higher than the credit growth, which means that deposit also was not a big constraint for most of these banks.
So what are the numbers? Because if the real constraint for banks to grow was the fact that deposits were expected to slow down, you're saying on a quarter-on-quarter basis, deposits have actually picked up and it's higher than the credit growth. Can you give us the numbers and what does this mean then?
Okay, so the deposit growth has been more closer to about 3% quarter-on-quarter compared to about 2-odd% for credit growth, right? So what it means is that for the banks which were going to be constrained on CASA growth, the ones with higher yielding segments could have been constrained if the deposit growth had not returned. Now that still is not a constraint now, and therefore with the note ban and other factors driving up liquidity, you will see that across segments, you will see strong loan growth.
Which are the banks where we've seen a strong deposit mobilization? Who could benefit?
Two or three factors at play here, Rima. I think one is you have a shift away from CASA to term deposits. So that is an industry-wide shift which is happening. So across banks, you will see that CASA growth slows down and term deposit rates would be the ones driving the overall deposit growth. The smaller two, then you have banks which can afford term deposits, which is those lending at higher yields. The smaller private sector banks, for instance, would see strong deposit growth, whereas those which are focused more on corporate side and therefore cannot afford to fund it through TDs would probably see a slower growth. The second is you've also seen a bit of repricing on CASA deposits. So a lot of banks have started putting out higher interest rates for SA accounts. Those banks would also see a stronger growth in deposits.
Okay. You want to leave us with your views on how PSU banks are shaping up, not just the larger guys like SBI, but also the rest of the pack. And also in terms of valuations, do PSU banks offer a better opportunity even now compared to private?
Yeah, I think they definitely trade at a lot lower valuations than the private sector banks. And there is still some room for them to grow in terms of their loan growth or deposit growth before the structural constraints start to kick in. Now, remember that the public sector banks have benefited from having excess liquidity in the last 12 to 18 months. There is still some excess liquidity left for them to use that to keep delivering growth on par with the private sector banks. So you will continue to see stronger EPS growth as well as growth almost on par with the private sector banks. The big question is once that is done, which probably is 6 months away, then the deposit growth will become a constraint for these public sector banks. That is probably where you will start seeing them underperform the private sector banks when it comes to earnings growth, etc.
Pranav, one question on HDFC Bank in particular. When they came out with the Q1 update, the street was very disappointed to see the lending growth number. I think it was just about 13%. And consensus expectations was that, maybe the bank would continue to see growth of high teens that it used to deliver. And that's what's been priced in. How would you read HDFC Bank's lending growth rate number that they reported in Q1? And does it mean that the bank is too big to continue to grow at those rates?
Good question. So I think the way I read it is that the headline number, yes, looks at 13 for the combined entity. But when you break it down and look at the gross loan growth, including the IPPCs, then the loan growth looks a lot stronger, right? So the bank standalone loan growth was closer to 20%. And if you combine with HDFC Limited's retail growth, even then the number looks healthy at about 19%. I think there are a few factors at play here, which leads to lower headline number. One is there is a rundown of non-retail book of HDFC Limited. These are loans that the bank does not want to put into the bank format. And second, there is also a balance sheet optimization which is happening. They are using IBPCs to kind of trim down the loan growth and manage the balance sheet transition. So to us, it appears like a one-off because the gross loan growth, including IBPC, still look good. And the retail deposits also looks good in terms of the year-on-year growth. So at this stage, we would think this is a one-off and not a change to the structural story of market share gains.
Any banks which might disappoint, according to you, this time? Where the street is being a little too optimistic?
I think the disappointment will be more on the margins front. I think for some of the smaller banks, despite growth into what I would call higher yielding or riskier segments, the ROA uplift might not be enough. So the disappointment, if any, would be more on the margin front rather than on the growth front.
Right, we'll let you go on that note. Thanks a lot for joining in and explaining to us what could be the outcome of the quarterly performance from the banking sector. Let's slip into a quick break. It's a very, very strong market, 118 points higher now, and the sensex inching towards 66,000. So big milestones there. Let's slip into a break. On the other side of the break, you have Mitesh Thakkar joining in with some technical trades. We will also talk about some of the buzzing stocks and trades.
Welcome back. It's 19,472 on the Nifty, holding up with a gain of about 116 points. Some stocks have seen a bit of a cool-off. Bajaj Finance has slipped in the last 10 minutes. Keep your eye on Divi's Laboratory. It's holding up in the green. It's up close to about 0.5%, but from the day's high, Divi's Laboratory has slipped nearly 1%. On the flip side, Infosys, TCS have moved to the day's high. Eicher Motors too has seen some buying. Last week, remember, Eicher Motors slipped close to about 10% in trade. But today, it's higher in trade. Mitesh Thakkar is with us now for some 10 a.m. trading ideas. Mitesh?
Yeah. I have two buys. One name you already mentioned, Infosys. I think, after that big move from 1260 to about 1350, the stock had cooled off. But looks like after a few days of consolidation, it's picking up again. So buy here with a stop at 1330 for targets of 1385. And the other one is Sun Team. We've been all focusing on Z, but Sun has moved up very nicely. This month is up about 7%. And it looks like to be in some kind of an uptrend, it's managed to get past the 200 average. So buy here with a stop just below levels of 458.5, which is the 200 average, and look for targets of 490.
Okay, targets of 490 on Sun TV, got that. Thanks a lot. The other stock that we're looking at is Cartrade. In case you missed out on the news earlier in the day, Cartrade has made an acquisition and they've acquired OLX India's auto business called Sobek Auto for a sum of 537 crores. And Cartrade has about 1,000 crores of cash on their books, so they've acquired it in an all-cash consideration. Sobek's Auto runs an automotive digital platform and a classified internet business, so it's pretty much in the same business as Cartrade. The acquisition is in order to bring synergistic advantages to Cartrade. So if you look at the financials of the company that they've acquired, Sobek's Auto, it's pretty good actually. It's gone up from 550 crores in FY20 all the way to 1,110 crores in FY22, and hence the street likes the acquisition. The stock is up almost about 14% in trade. But Tata.com is what you're looking at?
Yes, the stock has moved up close to about 4.5% in trade. The company announced that they have acquired the balance stake in a company called Oasis Smart SIM Europe. Now, this is a company which they had acquired a 58% stake in 2020. Now, the balance 58 to 100% stake, that's 42% stake, has been acquired by the company. So now this company, acquired company, Oasis Smart SIM Europe, will be a 100% subsidiary of Tata Communication. It was anyway a subsidiary because it held more than 50% stake, but now the ownership would stand at 100%, and the company has paid $12 million for acquiring the balance stake. So that's about Tata Communication, now up 5.3%. But let's talk about Mazgaon Docks. Parikshit is here.
Well, yes, Mazgaon Dock will be in focus. We are hearing that a very important submarine deal for 3 Scorpene submarines has been approved by the Defence Procurement Board, and this deal is going to be signed during the Prime Minister's visit to France. Now, these submarines will be built by Mazgaon Dock Limited, and Mazgaon Dock Limited has built other Scorpene submarines in the past. So, in a way, there is continuity. But yes, this is important for the government PSU. The other important deal that we're looking at is the acquisition of 26 Rafale jets for the Indian Navy. This has been on the cards for some time. It has cleared the first hurdle of the Defence Procurement Board, and now it goes to the Defence Acquisition Council. Both these deals are likely to be cleared on the 13th of July, and then will be cleared at the highest political level during the visit of the Prime Minister to France. At the same time, we're learning that companies like Thales, companies like Safran have shown a lot of interest, and there could be a deal for helicopter engines also on the cards, and a deal for co-development of jet engines between DRDO and Safran as well.
Right, thanks a lot for that. So the final approval of the deals, the defence deals, may come through on the 13th of July when the Defence Council meets. And a lot of these stocks are surging on the back of that. Mazgaon Dock, it was one of the top 10 stocks of the day. That is up almost about 9% reacting to it. Let's slip into a quick...
Cyan DLM. Remember yesterday's listing was up 58%. It opened up flat, was just up 1%. Now it's up 12%. So from the issue price of 265, the stock has just taken off in a span of 2 days. Get into that break then?
Oh, absolutely. And when we come back from the break, we'll talk about the economy. Lata will get chatting with Nischint Chavate, the director at Kotak Institutional Equities, about the expectations from NBFCs in the upcoming quarter.